After the pandemic, inflation returned to the world with force. Central banks reacted fast. Interest rates surged. Currencies were defended. But one country refused to move. While the United States and Europe tightened policy at the fastest pace in decades, Japan kept interest rates near zero. The yen slid to levels not seen in a generation. Import prices rose. Household costs followed, and still, Japan did not step in decisively. Why would an advanced economy accept a collapsing currency in the middle of a global tightening cycle? What was Japan protecting by letting the yen fall? This was not hesitation, it was calculation. Japan chose to weaken its currency in order to protect something larger than inflation targets or short-term growth. It chose to protect the stability of its entire economic structure. To understand why Japan made that choice, the story must first step back into how money became Japan's last line of defense. To understand Japan's decision, the story cannot begin with inflation or exchange rates. It begins with a moment when collapse became politically unacceptable. After the asset bubble burst in the early 1990s, Japan faced a choice that few advanced economies had confronted so early. It could allow banks to fail, unemployment to surge, and social stability to fracture, or it could slow the process of adjustment and preserve order. Japan chose preservation. Bad loans were rolled over instead of written off. Financial institutions were supported instead of liquidated. Growth slowed, but mass unemployment was avoided. Over time, this approach reshaped the role of monetary policy. Interest rates drifted lower year after year. When rates reached zero and growth still failed to return, Japan crossed a boundary other central banks hesitated to approach. Money was no longer just a tool to stimulate demand. It became a mechanism to prevent stress from surfacing. This transformation accelerated in the second decade of the 21st century. The Bank of Japan introduced large-scale asset purchases and later committed to controlling long-term interest rates directly. By capping government bond yields, the central bank removed volatility from the most important market in the country. This decision carried a quiet implication. If bond yields could not adjust upward, something else had to adjust instead. That something was the currency. In most economies, exchange rates reflect differences in growth prospects and interest rates. In Japan, the exchange rate increasingly reflected policy constraint. The yen stopped responding to domestic momentum and started responding to global divergence. Then came the pandemic. COVID disrupted supply chains, pushed energy prices higher, and reignited inflation across the world. Central banks elsewhere reacted with urgency. Interest rates rose sharply. Liquidity was withdrawn. Financial conditions tightened. Japan did not follow. With government debt far larger than annual economic output, raising interest rates carried extraordinary risk. Even small increases threatened to destabilize the bond market and strain public finances. The Bank of Japan chose continuity over convergence. As global rates climbed and Japan's remained near zero, the gap widened. Capital flowed toward higher returns abroad. The yen weakened steadily. This was not a failure of awareness. It was the predictable outcome of a system designed to prioritize internal stability over external balance. Japan accepted currency weakness because the alternatives were more dangerous. Defending the yen would have required tightening policy. Tightening policy would have forced a reckoning with decades of accumulated debt. That reckoning had been postponed for too long to be faced casually. By the time inflation returned globally, Japan's monetary framework had already made its choice. Money would absorb the shock. The system would remain intact. To see how this framework locks Japan into its current path, the analysis must now move deeper into the core mechanism that ties debt, interest rates, and the yen together. Japan did not lose control of its currency because markets turned against it. It lost control because arithmetic left no room to maneuver. Over more than 3 decades, Japan accumulated government debt on a scale unmatched by any other advanced economy. Public debt grew to more than twice the size of annual economic output. At that level, interest rates stop being a policy tool and become a threat. In a conventional economy, higher inflation leads to higher rates. Borrowing becomes more expensive. Demand cools. The system resets. In Japan, that mechanism broke long ago. Even a modest rise in interest rates would immediately raise debt servicing costs across the entire government balance sheet. With such a large stock of outstanding debt, Small rate changes translate into enormous fiscal pressure. Higher taxes, spending cuts, or sudden borrowing stress would follow. This is the trap. Japan cannot raise rates without destabilizing public finances. And because it cannot raise rates, the currency becomes the adjustment mechanism. When the Bank of Japan commits to holding long-term bond yields near zero, it sends a clear signal to global capital. Returns in yen will remain low for an extended period. Investors respond rationally. Capital moves outward. The exchange rate weakens. From the outside, this looks like policy failure. From inside the system, it is containment. The government bond market is not just another financial market in Japan. It is the foundation of the banking system, the anchor of pension funds, and the primary store of household savings. Any sharp repricing of bonds would ripple through every institution that depends on stability. Yield control exists to prevent that shock. By committing to buy government bonds at fixed yields, the Bank of Japan removes interest rate risk from the domestic system. But risk does not disappear. It moves. Instead of adjusting through higher yields, the system adjusts through a weaker currency. The yen becomes the pressure valve. Imported goods become more expensive. Purchasing power erodes gradually. Inflation arrives quietly, spread across millions of transactions rather than concentrated in financial markets. The cost is real, but it is diffused. This diffusion is intentional. Japan did not accept a weak yen to gain export advantage. It accepted a weak yen to avoid reopening a crisis it spent decades suppressing. Currency weakness was the least destabilizing outlet available. Once this choice is made, it becomes self-reinforcing. Low rates weaken the yen. A weaker yen makes rate increases more dangerous. Each year of delay tightens the constraint. At this stage, the yen no longer reflects economic strength or weakness. It reflects the price Japan pays to keep its debt from collapsing under its own weight. But debt arithmetic alone does not explain why Japan's currency problem became global. To understand that, the analysis must move beyond Japan's borders and into the role the yen now plays in international finance. The yen stopped being just Japan's currency when it became the cheapest source of money in the global system. For years, Japan held interest rates near zero while much of the world moved on. This transformed the yen into something more than legal tender. It became a tool, a funding instrument, a baseline for global leverage. The logic was simple. Borrow in yen at almost no cost. Convert into dollars, euros, or other currencies. Invest where yields still existed. As long as Japan kept rates anchored near zero and global volatility remained contained, this trade carried little friction. It was not driven by confidence in Japan's growth. It was driven by the absence of alternatives. After the pandemic, this dynamic intensified sharply. While central banks elsewhere tightened policy aggressively, Japan stood apart. The interest rate gap widened month after month. Borrowing in yen and investing abroad became increasingly attractive. Capital flowed outward at scale. This outward flow did not reflect panic or distrust. It reflected opportunity. Every yen borrowed and sold increased downward pressure on the exchange rate. The weaker the yen became, the more profitable the trade appeared. The cycle reinforced itself. This is how the yen evolved into the backbone of the global carry trade. Carry trades do not behave like long-term investments. They are sensitive to stability, not fundamentals. As long as policy signals remain predictable and markets remain calm, they expand quietly. When conditions change, they unwind abruptly. Japan understands this risk. A sudden signal of tightening could trigger a rapid reversal of capital flows. Borrowed yen would rush back. The currency would strengthen sharply. Asset prices elsewhere could fall. Volatility would spike. This is why policy communication became cautious to the point of opacity. The goal was not clarity, it was continuity. Avoiding surprise became more important than signaling intent. In this role, Japan is no longer managing only its domestic economy. It is managing a component of global liquidity. By keeping rates low, Japan supplies funding to the rest of the world. By allowing the yen to weaken, it absorbs pressure generated by global tightening elsewhere. Growth and asset appreciation abroad are partially financed by Japan's suppressed returns at home. This creates a structural imbalance. Japan exports monetary accommodation while importing inflation. Foreign markets benefit from cheap funding. Japanese households bear higher costs. Yet the system persists because the alternative is disorder. Defending the currency would require higher rates. Higher rates would reprice decades of accumulated debt. The trade-off is unavoidable. As the yen's role in global finance deepens, Japan's room to change course narrows. Each year of reliance increases the cost of exit. What began as a domestic policy choice hardens into an international constraint. The yen is no longer just a reflection of Japan's economy. It is a stabilizing component of the global financial system, but stability built on leverage is fragile. To understand who ultimately pays the price for this arrangement, the analysis must turn inward again, toward the domestic consequences of living with a permanently weakened currency. A weak currency does not announce itself with crisis. It arrives through everyday life. For Japan, inflation after the pandemic did not begin with excessive demand or rising wages. It began with exchange rates. Energy, food, raw materials, and shipping costs rose as the yen weakened. Almost all were priced in foreign currency. Almost all became more expensive overnight. Japan imports nearly all of its energy. It relies heavily on imported food and industrial inputs. When the yen falls, costs move immediately. There is no delay and no insulation. This is imported inflation. Unlike demand-driven inflation, imported inflation does not come with offsetting income growth. Prices rise, but wages do not follow at the same pace. Purchasing power declines quietly. Households feel this first. Electricity bills increase. Fuel prices climb. Grocery costs edge higher month after month. Rent adjusts slowly, then permanently. None of this feels dramatic in isolation. Together, it reshapes living standards. Wage growth does occur, especially during annual negotiations, but nominal gains struggle to keep up with the cost of living. Real wages remain under pressure. Savings buy less. Consumption becomes cautious. This is not an accident of timing. It is the social cost of monetary design. A weak yen benefits exporters, large corporations, and tourism. Foreign visitors return in large numbers. Corporate profits improve in yen terms. Equity markets respond positively. For households, the experience is different. Higher prices arrive without a corresponding sense of opportunity. Inflation is not the result of growth. It is the consequence of currency weakness. The burden is spread across millions of small transactions, making it difficult to identify, organize against, or reverse. This diffusion is precisely why the system holds. Japan's economic model depends on social stability. Sharp shocks are avoided. Adjustments are gradual. Pain is distributed thinly enough to prevent rupture. Imported inflation fits this logic. Rather than allowing financial markets to absorb stress through volatility, Japan allows households to absorb it through reduced purchasing power. The impact is real but slow. It does not trigger immediate institutional crisis. Over time, however, the effects accumulate. As prices rise faster than incomes, expectations adjust downward. Consumption weakens. Risk-taking declines. Younger generations delay spending, investment, and family formation. The economy becomes defensive. This is how stagnation deepens without collapse. The danger is not sudden instability. The danger is normalization. When households accept lower real incomes as permanent, economic ambition erodes. Growth becomes harder to restart, not because policy fails, but because behavior adapts. Japan has chosen this path knowingly. Imported inflation is considered manageable. A bond market crisis is not. But currency weakness does not exist in a vacuum. The consequences extend beyond borders, reshaping trade, capital flows, and geopolitical balance. To understand how Japan's domestic trade spills into the global system, the analysis must widen its lens once more. Modern currency conflict does not begin with declarations. It emerges from divergence. After the pandemic, the global monetary system fractured. Some economies treated inflation as an existential threat. Others treated instability as the greater danger. Japan placed itself firmly in the second group. This divergence transformed the yen into a geopolitical variable. While the United States and Europe raised interest rates aggressively, Japan refused to follow. The result was not just a weaker currency, It was a structural shift in how monetary pressure was distributed across the global system. Japan did not weaken the yen to gain advantage. It weakened the yen to avoid confrontation. Yet the effect resembles a form of currency warfare. A weaker yen reshapes trade flows. Japanese exports become more competitive. Imports become more expensive. Foreign producers face pricing pressure. Domestic firms gain breathing room. None of this requires intent. It is the mechanical outcome of policy divergence. Other economies notice. For the United States, Japan's stance reinforces dollar dominance. Capital flows toward higher yields. American financial markets absorb global liquidity. The dollar strengthens, extending its influence. Stability at home is preserved by exporting tighter conditions abroad. For Europe, the yen's weakness adds strain. European manufacturers compete against Japanese firms operating with a structurally cheaper currency. Monetary tightening becomes harder to sustain without sacrificing growth or competitiveness. China observes carefully. Its own currency is managed tightly, not floated freely. China avoids both sharp depreciation and aggressive tightening, preferring control over volatility. Japan's model offers a contrast: credibility over control, endurance over adjustment. Emerging markets feel the impact most directly. Yen-funded carry trades amplify capital flows. When risk appetite is high, money pours in. When conditions change, it exits rapidly. Volatility increases. Local currencies absorb shocks that originated far from domestic fundamentals. This is how Japan's internal choice becomes a global force. No tariffs are imposed, no sanctions are declared, yet monetary decisions redraw the map of advantage and vulnerability. Japan does not fight currency wars. It simply refuses to participate on equal terms. There is a deeper irony. By prioritizing stability, Japan reduces its own freedom of action. As the yen becomes embedded in global funding structures, any attempt to change course carries international consequences. Tightening risks, triggering rapid capital reversals. Defending the currency threatens domestic balance. The cost of action rises with every year of inaction. Japan becomes systemically important not because it leads, but because it anchors a fragile equilibrium. Its currency is no longer just a national instrument. It is part of the architecture of global finance, and architectures resist change. At this stage, the question is no longer whether Japan can win a currency conflict. It is whether Japan can ever exit one that was never formally declared. To answer that, the analysis must move forward toward comparison, consequence, and what Japan's choice reveals about the future of the global economy. Japan's monetary stance appears extreme only when viewed alone. Placed beside other major economies, it becomes a reference point for how different systems choose to absorb stress. After the pandemic, every major economy faced the same problem. Inflation returned. Debt levels were high. Political tolerance for disruption was low. What differed was where each system chose to place the burden. The United States chose confrontation. Inflation surged, and the response was immediate. Interest rates rose at the fastest pace in decades. Financial conditions tightened sharply. The dollar strengthened. Growth slowed, but credibility was restored. This approach stabilized prices at home while exporting pressure abroad. Higher rates pulled capital inward. Emerging markets struggled with debt servicing. Global liquidity thinned. Stability was preserved domestically by allowing volatility elsewhere. Japan chose the opposite. Instead of absorbing the shock early, Japan diffused it over time. Rates remained low. Debt markets were protected. The yen weakened. Inflation arrived slowly through imports rather than suddenly through financial markets. The contrast reveals two philosophies. The United States prioritized price stability and market discipline. Japan prioritized continuity and institutional survival. Europe attempted a middle path. Energy shocks and fragmented fiscal authority constrained its response. Rates were raised to defend the euro, but growth suffered. Industrial competitiveness weakened. Social pressure rose as living costs climbed faster than wages. Europe preserved currency credibility, but at the expense of momentum. Its challenge mirrors Japan's future risk, defending money while slowly eroding growth capacity. China followed a different logic altogether. Rather than relying on interest rates, China leaned on administrative control. Capital flows were managed. The currency was guided within narrow ranges. Sharp depreciation was avoided to prevent capital flight. Aggressive tightening was avoided to protect employment. China internalized adjustment through control. Japan externalized adjustment through the currency. Both delayed confrontation. Both preserved stability. Neither solved the underlying demographic and debt constraints. South Korea sits uncomfortably between these models. Its economy is export-driven and technologically advanced, but its population is aging faster than almost any other. Household debt is high. Unlike Japan, Korea cannot hold rates near zero without risking capital flight. Unlike China, it cannot tightly control flows. Every shift in global liquidity tests its resilience. Korea illustrates how narrow the margin for error has become for mid-sized economies operating in a fragmented system. Together, these choices have reshaped the global monetary landscape. Instead of a synchronized cycle, the world now operates in divergence. Strong currency zones tighten. Weak currency zones absorb pressure. Capital moves opportunistically. Volatility concentrates at the edges. Japan's role in this system is unique. By remaining accommodative, Japan dampens global tightening. By allowing the yen to weaken, it stabilizes debt markets at home and liquidity abroad. It acts as a silent shock absorber, but shock absorbers wear down. The longer divergence persists, the more distorted capital allocation becomes. Asset prices drift away from fundamentals. Productivity weakens. Inequality widens between those who benefit from capital flows and those who pay higher living costs. Japan did not create this fragmentation, but it has become essential to sustaining it. And that raises a final comparison. If aging populations, high debt, and political resistance to pain define much of the developed world, Japan may not be an exception. It may be a preview. The question is not whether Japan's path is sustainable for Japan alone. It is whether a global system can function if too many economies choose delay over adjustment. To answer that, the analysis must now turn toward the future choices that remain and the limits of avoiding collapse indefinitely. Japan's dilemma is not a lack of options. It is that every option contradicts the logic the system has relied on for decades. After years of suppressing volatility, Japan now faces a narrow corridor of possible exits. Each path avoids one danger by inviting another. The first path is continuation. Interest rates remain near zero. Yield curve control is loosened cautiously, but not abandoned. The yen stays structurally weak. Inflation fluctuates at low levels. Growth remains modest. This path does not resolve Japan's problems, it manages them. Debt is rolled forward rather than reduced. Fiscal pressure is absorbed through gradual erosion of purchasing power, targeted subsidies, and demographic adjustment. Stability is preserved, but momentum never returns. Stagnation becomes a governing principle rather than an unfortunate outcome. The second path is controlled normalization. In this scenario, the Bank of Japan allows long-term yields to rise slowly. Policy communication emphasizes predictability. Wage growth is encouraged to outpace inflation. Fiscal reform begins in limited form through selective tax adjustments and restrained social spending. If executed perfectly, this path stabilizes the yen, reduces imported inflation, and restores a measure of confidence. The carry trade unwinds gradually. Financial markets adjust without panic. But this path requires precision rarely achieved in reality. Move too quickly, and bond markets react. Move too slowly, and credibility erodes. Monetary normalization without fiscal reform risks debt stress. Fiscal reform without growth risks political backlash. Coordination across institutions becomes the central challenge. The third path is not chosen. It is imposed. A global financial shock, a sudden reversal in risk appetite, a geopolitical disruption, or a disorderly unwinding of carry trades triggered by volatility elsewhere. In this scenario, capital rushes back into yen assets. The currency strengthens abruptly. Bond yields rise despite intervention. The Bank of Japan is forced into a binary choice: defend the bond market or defend the currency. This is the scenario policymakers fear most. Adjustment under pressure concentrates pain instead of diffusing it. Stability unravels quickly. The very system designed to prevent collapse becomes fragile. Across all scenarios, one constraint dominates: demographics. An aging population limits growth potential, increases fiscal burdens, and reduces tolerance for disruption. No monetary strategy can reverse this quickly. At best, policy can buy time. This is why Japan's choices feel circular. Growth is needed to escape debt. Debt constrains growth. Currency weakness buys time. Time deepens stagnation. The system remains internally consistent but increasingly brittle. Japan's leaders understand this trade-off. That is why policy has favored predictability over ambition, delay over confrontation, and stability over transformation. The unresolved question is not whether Japan's strategy is rational. It is whether rational delay eventually becomes irrational persistence. And that question cannot be answered by models alone. It depends on society's willingness to accept gradual decline in exchange for order, and on how long order can be maintained without renewal. To bring the story to its final conclusion, the analysis must step back and ask what Japan's experience reveals about money, power, and the cost of avoiding collapse. Japan did not drift into stagnation by accident. It constructed a system designed to survive without rupture. Confronted with overwhelming debt, unfavorable demographics, and a financial structure built on stability, Japan made a deliberate choice. It kept interest rates low. It protected its bond market. And when global tightening arrived, it allowed the yen to absorb the shock. This decision changed the role of money. The yen stopped functioning as a signal of growth or competitiveness. It became a stabilizing instrument, a release valve for pressure that could not be allowed to surface elsewhere. Imported inflation, declining purchasing power, and subdued living standards were accepted as manageable costs compared to the risk of systemic failure. From the outside, this looks like decline. From within the system, it looks like control. Japan's experience reveals a broader truth about modern economies. When debt is high and populations are aging, traditional policy goals shift. Growth becomes secondary. Renewal becomes optional. Stability takes priority. This is why Japan matters beyond its borders. The conditions Japan faces are no longer unique. Aging societies, rising debt, and political resistance to disruption now define much of the developed world. What Japan chose first, others may soon be forced to consider. The real question is not whether Japan's strategy is correct. It is what happens when too many economies make the same trade-off. If every system delays adjustment, where does the pressure go? If every currency becomes a pressure valve, what breaks? Japan's story is not a warning of imminent collapse. It is a warning about permanence. An economy can survive indefinitely without renewal, but survival without renewal slowly changes what survival means. Understanding this trade-off is no longer optional. It is essential for anyone trying to understand how money, power, and stability interact in the modern global economy. If this analysis helped clarify how currency choices shape everyday life, consider subscribing to the channel and sharing the discussion. These dynamics are not confined to Japan. They describe a direction the global system may already be moving toward. The earlier that direction is understood, the fewer choices remain invisible.